Do not follow where the path may lead. Go instead where there is no path, and leave a trail. Ralph Waldo Emerson believed the world was separated into two groups, the establishment and the movement, the latter representing those who would drive progress by presenting new thoughts and ideas. As I reflect on our journey and results of this past year, I'm reminded of Emerson's words and believe that in many ways, we too are creating a movement, moving through multiple transformative stages that have defined our brand and redefined our industry. While we believe the ideas of the future don't exist in the past, taking a moment to look back on how far we've come might put where we are going and what we are capable of into perspective. How does a brand called Restoration Hardware that defined itself by selling nostalgic discovery items like an Aquatrol, a shoe shine kit, or Auto Bingo transform into RH, the leading luxury home brand in the world? How does a retailer with an average store volume of 2.9 million grow its average store volume to more than 10 million in the exact same real estate? How does a company with a $20 million market cap, no capital, and teetering on the edge of bankruptcy in 2001, become a company with a market value in excess of $3.5 billion in 2015, up 175 times from 2001 with a strong capital structure and significant growth opportunities? History has taught us that real value is created by those who have the courage to lead rather than follow, who are willing to destroy today's reality to create tomorrow's future. At our core, we are innovators. We obsessively search for opportunities to destroy the current version of ourselves to create something significantly more valuable. It's based on Joseph Schumpeter's notion of creative destruction and what he referred to as leapfrogging. His hypothesis proposed that companies holding monopolies based on incumbent methodologies have less incentive to innovate than potential rivals. They eventually lose their leadership role when radical new innovations are created by firms willing to take the risks. When the radical innovation becomes the new paradigm, the new companies leapfrog ahead of the former leading firms. No different than Apple leapfrogging past Dell, Hewlett-Packard, IBM, and Microsoft, we believe RH will leapfrog past every current player in the home furnishings industry today. In every area of our business, we are focused on creatively destroying the current version of ourselves to unleash a better one. Our approach is disciplined and systematic. We assess competitors looking for opportunities to disrupt current markets and create new ones where none exist. We like to say we have to think until it hurts so we can see what others can't see and do what others can't do. We then deploy our human and financial capital where we can drive meaningful change and create maximum value. And while all value creation involves some degree of risk, we search for asymmetrical returns where our upside is significantly greater than our downside. Over the years, we have demonstrated that we can test, scale, and roll out new ideas predictably and profitably. Much of our success is due to significant infrastructure investments we have made and the unique platform we have built. One such investment is the RH Center of Innovation and Product Leadership, a facility unlike anything in our industry. It's a 120,000 square foot space designed to support the creative process from ideation to presentation, and has enabled us to increase our productivity by 500%. Despite our results, we are often questioned about the number of initiatives we are pursuing or at the speed in which we are moving. What's often overlooked are the many things we've chosen not to do. And in many cases, it's where others have followed blindly based on the latest strategy du jour. Let me give you a couple of examples. As you can see on this graph, we don't have many Facebook likes compared to our competitors. That's because we don't have a Facebook page. We don't have any Pinterest followers, yet we are one of the most pinned brands in our industry. We also don't have a Twitter or Instagram account, yet our rain room installation at the MoMA was one of the most tweeted and Instagrammed events of the past several years. And our new design galleries in Boston, Greenwich, Los Angeles, and Atlanta have become social media stars in their own right. We don't have a blog because we believe it's not what you say about yourself, it's what people are saying about you that matters. We don't have an elaborate digital strategy conjured up by a fashionable digital agency because we are not a digital company. Digital companies primarily create content, connections, and serve up information, much like media companies, and sell advertising. We are a product company. We are focused on curating the very best product, people, ideas, and inspiration, and then integrating them to create a point of view that is authentic and distinctively our own. We then present those products across any and all relevant channels and amplify their meaning with an experience and service designed to render them more valuable. So while we don't have a Facebook page, our own blog, a Pinterest board, or an Instagram or Twitter account, what we do have compared to our competitors is this: the leading revenue growth in our industry over the past 5 years, the leading comparable brand growth in our industry over the past 5 years, the leading earnings growth in our industry over the past 5 years, and we are the top performing retail consumer IPO in the past 6 years, as our stock is up 270% since our offering in November of 2012. We believe our performance is the result of our focus on creative destruction, on innovation versus duplication, and our ability to allocate both human and financial capital to create meaningful value for our shareholders and our customers. Since I'm focused on results, let me also point out some of our highlights from 2014. 2014 was our 5th consecutive year of at least 20% revenue growth, and we have averaged 25% revenue growth over that time period. After 4 consecutive years of achieving comparable brand comps of at least 25%, a milestone unseen before in our industry, we achieved comparable brand comps of 20% in 2014, on top of 31% a year ago. Our operating margin increased 150 basis points to 9.3% versus 7.8% last year, putting us in a position to leapfrog the operating margin of the firm many point to as the gold standard in our industry. Adjusted net income grew 41% in 2014 on top of 83% growth a year ago. And in fiscal 2014, our stock appreciated 54%. We also opened our first next-generation design gallery in Atlanta, which is being hailed as the most important new home store in our industry. These next-generation galleries successfully integrate all of our current concepts: RH Interiors, RH Small Spaces, RH Baby and Child, and RH Outdoor, and they're designed to incorporate the multiple new businesses we have in our product development pipeline. While many have been predicting the death of the retail store, we have continued to innovate and build a retail experience that defies conventional wisdom that everything is moving to the web and retail stores are a dying platform. We have proven just the opposite, developing new, larger galleries that blur the lines between residential and retail, indoors and outdoors, physical and digital, and create an experience that cannot be duplicated online. We find it serendipitous that the recent trend of previously online-only retailers are now opening physical stores. People like Bonobos, Birchbox, and even Amazon. Warby Parker, who Fast Company magazine just named the most innovative company in the world for building the first great made-on-the-internet brand, is now also opening retail stores. Scott Galloway, professor of marketing at the Stern School of Business at NYU and founder of L2, a think tank for digital innovation, calls stores the new black and has predicted the death of pure play. Consulting group A.T. Kearney, in their recent report titled On Solid Ground, said brick and mortar is the future of modern retailing, and it's not physical or digital, it's physical with digital. We have always believed that while the web presents a revolutionary new way to shop, a retail store by far presents the best opportunity for the physical manifestation of a brand. What many online advocates miss is a website is an invisible store. You don't see it in the physical world. The other disadvantage to online-only businesses is that a website is completely democratic. The smallest store in the world can appear to be as large as the biggest store in the world online, as everyone has the same size storefront. You have to click through thousands of pages on a website to get the same impression you can achieve by spending a few minutes in a retail store, or in many cases, just driving by. So while many have assumed our strategy was misguided, we believe transforming our retail stores will prove to be the single best investment we make. As we look forward to 2015, there are several innovations and initiatives I would point you to. The first is the opening of 4 new next-generation design galleries. This fall, we will open RH Chicago, the gallery at the historic 3 Arts Club, RH Denver, the gallery at Cherry Creek, RH Austin, the gallery at the Domain, and RH Tampa, the gallery at International Plaza. Ranging from 45 to 65,000 square feet of indoor and outdoor selling space, you really have to see these new galleries to truly appreciate how revolutionary the shopping experience is, how uniquely they position and differentiate the RH brand, and the ongoing potential for disruption and market share gains. The second innovation I would point you to is the evolution of our sourcebook strategy. As we continue to test and learn, we believe we can meaningfully improve the productivity of our sourcebooks. This year, we will be mailing our outdoor books separately and earlier than a year ago. We are launching 14 new outdoor collections this spring and believe some of our new modern and contemporary collections will open up the brand to new customers. From homes to hotels, beaches to balconies, poolsides to patios, we have the most comprehensive collection of high-quality outdoor furniture in the country and expect meaningful growth from this category in 2015. We have also consolidated some of our sourcebook titles, densified our pages, and will be testing mailing depth by title. We believe we can drive increased revenues while reducing advertising spend and further expand on our operating margins. The third initiative I would point out is the continued innovation in our supply chain. We are opening a new West Coast facility this spring. We continue to insource our home delivery hubs. We've made meaningful improvements in how we flow and deploy inventory, and we will roll out our final mile home delivery system this year, all of which should lead to improved fulfillment, lower back orders, reduced stops per delivery, lower returns and damages, and an improved customer experience and increased profitability. Lastly, we plan to launch 2 meaningful new businesses this fall, each with their own source books. These new initiatives will serve new markets, and both should be incremental to our current business. As I reflect on this past year, there is another point I would like to make. Every now and then, a friend or family member will ask me if they should buy our stock, and I always ask them the same question: are you a trader or an investor? Because as you know, there's a big difference. Traders look for short swings and bet on short-term movements or outcomes. Investors, on the other hand, generally focus on value creation over a longer horizon. Investors have a bias for building versus betting. They tend to be advocates versus adversaries, and realize that building great businesses and brands takes years, not months or quarters. We too are investors. We deploy human and financial capital where we believe we can create long-term, lasting value for ourselves and our shareholders. We make investments like we own 100% of this business, and it's the last place we will ever work. We don't believe it's wise nor possible to measure those investments in days, months, or quarters that can be affected by short-term, episodic events. We also know that every investment we make or plan we develop is some degree of wrong. The key to our success at our age is having a portfolio of investments that in aggregate have asymmetrical returns. That there is significantly greater upside than downside, and we have developed plans that are positioned to protect the enterprise in the event of an unforeseen downturn. Therefore, we encourage you, like we do our friends and family, to only purchase our stock if you are an investor, if you have a long-term view and want to be part of building a meaningful enterprise. Let me end with a few thoughts that are at the very core of everything I've spoken about today. It's the essence of why, against all odds, we are still here. Why an irrelevant money-losing brand selling nostalgic discovery items with a market value of $20 million went on to become one of the most innovative and fastest-growing luxury brands in the world with a market value in excess of $3.5 billion. It goes beyond what we have done, but rather who we have become. We have become a team of people who don't know what can't be done. A team of people who don't work for a company, but rather a cause. A team of people who are defined by our values and beliefs, those things we live for, would fight for, and die for. A team of people who believe in leadership versus followship, innovation versus duplication, and are driven and determined to define next practices versus best practices. What's most important is who we are, how we think, and what we believe in. That's why we will continue on a path of creative destruction and leapfrog every other business in our industry. As I mentioned last year, we are like a $1.9 billion startup in the very early stages of a highly evolutionary business moving through multiple transformative stages that will define our brand and, more importantly, redefine our industry. History has taught us that real value has been created by those who have the courage to lead rather than follow, who are willing to destroy today's reality to create tomorrow's future. We, like Emerson, are passionate about creating our own path and leaving a trail. Thank you for joining us.
The many transformative changes that we have made in evolving our business model are leading us down a clear path towards significant shareholder value creation. As we step back and reflect on our performance in fiscal 2014, there are several meaningful financial achievements we are proud of, including posting our 5th consecutive year of net revenue growth in excess of 20%, delivering 150 basis point expansion in our operating margin, reaching 9.3% for the year, achieving a 41% increase in adjusted net income, quality earnings growth that was primarily driven by 110 basis point expansion in our gross margins, reporting adjusted diluted EPS of $2.36, well ahead of our original outlook of $2.14 to $2.22, with the fourth quarter representing our 8th consecutive quarter either meeting or exceeding our earnings guidance, and the significant strengthening of our balance sheet in fiscal 2014, successfully executing a $350 million 0% coupon convertible notes transaction, with terms rarely, if ever, achieved in our industry. Our recent achievements demonstrate how far we have come and how much our business model has evolved in our short time as a public company. Looking back at the transformative changes we have made and the current strength of our business, we have even more confidence in achieving our long-term goal of reaching $4 to $5 billion in North American revenues with a mid-teens operating margin. First, I want to touch on the evolution of our growth strategy. At the time of our IPO, less than 2.5 years ago, we believed there was a significant opportunity to unlock the value of our product assortment by displaying a greater amount of our offer in larger format stores. At that time, our real estate strategy was to open stores that were an average of 21,000 square feet in approximately 50 markets. Today, we believe we have an opportunity to open next-generation design galleries in the top 60 to 70 markets, representing more than twice the square footage of our plans at the time of our IPO. Today, landlords view RH as an anchor tenant in some of the best centers in North America, enabling us to secure economics previously unattainable by a specialty retailer. Today, our real estate pipeline is strong, with 9 leases currently signed for 2016 and beyond, and an additional 25 locations that have been identified or are in advanced negotiations. Second, I want to discuss the significant impact our real estate transformation is having on our long-term revenue outlook. Just over 2 years ago, our plan contemplated that the average 21,000 square foot full-line design gallery would generate $18 million in retail sales, or nearly 2 times that of the legacy store in that market. Today, we believe that our next generation design galleries will average 45,000 square feet and generate $30 million in retail sales, approximately 2 to 4 times the legacy store volume in each market. Our first next generation design gallery, RH Atlanta, the estate at Buckhead, is our first gallery to incorporate all of our current concepts under one roof: RH Interiors, RH Small Spaces, RH Baby and Child, and RH Outdoor. It has also been designed to accommodate several new businesses that are in development, including RH Kitchen and many more which will be announced in the near future. We are very pleased with the initial results, and the direct lift we are seeing in this market has been one of the strongest thus far. The combination of the sales volumes these next-generation design galleries are expected to generate, coupled with the corresponding direct lift that we experience in each market, and the continued expansion of our product offering, allow us to see a clear path toward generating $4 to $5 billion in total company sales once our real estate transformation is complete. Third, we've become more disciplined than ever in our approach to deploying capital. We go through a rigorous process that's designed to focus on investments into strategies that drive the greatest financial and strategic value. We are mindful of the need to invest in building an infrastructure that can support our long-term growth while delivering a luxury service experience. This is an area of particular focus as we believe there is a significant opportunity to improve our service experience, leading to increased sales and lower costs. You will hear more about our initiative to elevate our quality and service experience as we get further into the year. We've been more measured with the pace in which we roll out our larger format galleries for 3 reasons. 1, the reality is our real estate strategy is unlike anything seen before in specialty retail. This is not a simple cookie-cutter rollout. Each new gallery is a complex development deal requiring principal-to-principal relationships and negotiations, shopping center expansion or reconfiguration, and complexities that can prove very costly without a measured and disciplined approach. 2, we are learning a tremendous amount with each of the first new galleries and want to ensure we have the time to make adjustments and perfect the model so we can maximize the returns over the long term. 3, these are 18 to 36-month development deals, and it is difficult to predict what complications might arise due to tenant relocations, department store approvals, incremental parking requirements, or local permitting issues. Despite the fact that our real estate transformation will take longer than previously anticipated, and 2015 will be a bridge year with square footage growth at the low end of our range, we are confident we can achieve our long-term target of 20% plus revenue growth once our development pipeline ramps in 2016. Furthermore, despite our focus on even larger format stores than planned at the time of our IPO, our next generation design galleries will require less net capital per gross square foot to build and generate a higher return on invested capital than initially contemplated. We assumed that our build-outs would cost roughly $250 in net capital per gross square foot, and we expected that the average payback would be 20 months. Today, we expect to spend 20% less per foot and are planning an average payback period of 12 to 18 months. If we were to include the lift in direct sales that we experience in each market, that payback would be even faster. The transformative changes have occurred in almost every area of our business. We have further evolved our product development and vendor collaboration processes, made transformative changes in our supply chain, and continued to evolve our sourcebook strategy over the last few years. These changes, coupled with our continued market share gains, have allowed us to see significant operating margin expansion. Putting it into perspective, we ended fiscal 2014 with operating margins of 9.3%, up 350 basis points in 2 years. In fact, just over 2 years ago, we were targeting a 10% plus operating margin in our long-term model once our real estate transformation was complete. Today, we expect to achieve industry-leading operating margins in excess of 10% in fiscal 2015, putting us further along the path toward our long-term target of operating margins in the range of 15 to 16%. Let me remind you how we get there. First, we expect gross margin expansion of roughly 300 basis points, driven by retail and DC occupancy leverage of approximately 200 basis points, and approximately 100 basis points from merchandise margin expansion and shipping efficiencies as we gain further pricing power, see improved vendor pricing, and benefit from the efficiencies of our home delivery insourcing initiative and optimization of our shipping model. Within SG&A, we see 300 to 400 basis points of improvement in our long-term model. We expect to see advertising cost leverage of at least 200 basis points as we leverage our ad spend in each market as we roll out our next generation design galleries and as we further optimize our sourcebook strategy. In addition, we expect to see 100 to 200 basis points of other SG&A improvement as we leverage our fixed corporate and other G&A expenses with the higher sales volumes contemplated in our long-term model. The final point I would like to reflect on is the current state of our balance sheet and our path toward free cash flow generation and higher returns on invested capital. 2 years ago, our long-term real estate transformation was being funded by short-term borrowings. Our only source of liquidity was through our asset-based line of credit. Today, we are confident we have the liquidity to withstand any economic downturn or other event. The $350 million 0% convert allowed us to pay down our line and has also provided tremendous leverage and flexibility in negotiating our next generation design gallery leases, ensuring we optimize the capital construct and unit economics of each and every deal. We also expanded the availability of and reduced the fees and borrowing rates on our line of credit. Furthermore, we feel even more confident in how we've been able to manage our working capital and our ability to generate free cash flow. We continue to see a near-term path to becoming free cash flow positive and expect to reach this important goal within the next 12 to 24 months. We are proud of all that we have accomplished and are well positioned as we enter fiscal 2015. As I mentioned, 2015 will be a bridge year for RH with revenue growth targeted in the mid-teens, and then re-accelerating to the low 20s as our real estate transformation begins to ramp in 2016. For fiscal 2015, we expect net revenues to grow in the range of 14 to 16%. Our ending leased selling square footage is expected to increase approximately 27% in fiscal 2015, with all of that growth coming in the third and fourth quarters. As I referenced earlier, our plan to enhance the productivity of our source books, coupled with continued gross margin expansion, give us great confidence in achieving operating margins in the 10% plus range this year. While 2015 will be a bridge year as it relates to our top-line growth, we expect our earnings growth to exceed our long-term targets as we are planning net income in the range of $125 to $131 million, up 28 to 34%, and deliver diluted EPS in the range of $2.95 to $3.10, representing growth in the range of 25 to 31% from fiscal 2014. In summary, we have never been more proud of our performance or more confident in our outlook. We are exiting 2014 with even more optimism about the opportunities that lie ahead. We will cross both the $2 billion sales and 10% operating margin marks in 2015, significantly faster than we communicated at the time of our IPO just over 2 years ago. We continue to demonstrate that we have the fastest growing and one of the most profitable businesses in the home furnishings industry. We see a clear path to achieving our long-term goals of $4 to $5 billion in net revenues with mid-teens operating margins. And we expect to reach free cash flow positive in the next 12 to 24 months. As Gary mentioned, we're in the early stages of one of the most exciting and compelling transformations in all of retail. And we plan to continue on our path of creative destruction, leapfrogging past everyone else in our path. We would like to thank every single member of Team RH, both our people and our partners around the world. Thank you for your commitment to our cause, and as Ralph Waldo Emerson described, for being part of our movement.